the difference between index funds and active funds? Which is better for an investor? Our chief financial planner, Mr. Ramalingam, will elaborate on this. Ramalingam, over to you.
Index funds, they simply buy all the stocks in the index in the same weightage. Let us say a large cap fund following Nifty 100 or BSE 100, they will buy all the 100 stocks in the book in the same proportion. In other words, index fund manager is not applying his brain. Simply, he will do cut, copy, paste of the index. He will not look at the portfolio. He will not look at the sustainability. He will not look at the profit and loss, whether the company will make profit or not in future. He is not at all worried. He will simply mimic the index, cut, copy, paste the index. Simple. Yes, index funds are also giving you decent returns. As I told, the Sensex has delivered 12.5% return between 2013 to 2023. Nifty has delivered 12.65% between 2013 to 2023. If you would have invested in an index fund, it would have given you similar return. Agreed. Whereas in the actively managed, the fund manager picks and chooses the best of the best stocks from this 100. He'll also have 20% exposure to other stocks. So in that case, the fund manager has got much better prudence in selecting stocks. Because of that, he'll be able to generate additional alpha, additional returns for investors. Because he is able to generate additional returns, he charges more expense ratio. Over and above that expense ratio, he delivers additional return. That is the key point here, because many a times people have this comparison. Index funds have low expense ratio, or actively managed funds have like a high expense ratio. Why should I pay high? In mutual funds, NAV is post expenses. So you need not worry about expense ratio here. Post expense NAV is declared, whether the NAV is giving you more than index return. Actively managed equity funds have delivered 70 to 80% of the actively managed equity funds have delivered above average returns. They have delivered more than index returns. So choosing an actively managed fund really helps, especially during that Adani episode where the Hindenburg report got like out. Index funds were forced to have Adani stocks because it's part of index. Actively managed fund managers who understood the Adani stock prices are like overvalued, they sold it well in advance. In index funds, it is not possible, right? In index funds, they are forced to invest. Whatever is there in the index, they are forced to invest. That is a problem with index funds. And in index funds, there is one more challenge. The basic investment principle says you have to buy low and sell high. As a fund manager, like when a stock is at low price, I will buy. When it is at a high price, I will sell. This is the basic investment principle a fund manager wanted to follow. In index fund, it is not possible for a fund manager to buy low and sell high. How? Let us say there is a stock in Nifty 100 which is there in the 100th position. The stock is not doing well. So soon this stock will be replaced by other mid cap stocks which will come to that 100 position. This stock will go out of index. Whereas in the actively managed fund, if the stock is not doing well, the active fund manager can sell it immediately. They can buy that stock which is going to replace that stock in the index well in advance. Whereas in the index fund, the fund manager cannot do it. He has to wait. He has to wait till the stock is kicked out of index. By the time everyone knows that the stock is not doing well, it's going to be kicked out of index, share price could have come down because everyone is selling. The replacing stock could have gained momentum. Everyone could have started buying that stock. Stock price could have went up. Index fund will sell after most of the investors have sold that stock. Index funds will buy after most of the investors have bought that stock. So obviously they will not be able to buy at low rate. They will not be able to sell at a high rate. They will be buying at slightly higher rate. They will be selling slightly at lower rate. So this is another problem with index funds. And index funds, though they are mimicking the index fund, all the index funds generate less than index returns on record. Why? Index funds have two issues. One is they will not be able to generate more return than the index, and they have to charge an expense ratio. So index returns minus expense ratio is what they are return. First one. Number two, there is a tracking error. They can't simply mimic the index. So I told you, right? 100 stock is getting replaced by another stock. They can't sell that 100 stock on a single day. They have to do it in a phased manner for a week or 10 days. The replacing stock also, they can't buy it on the same date. They have to buy it in a phased manner. So there will be a tracking error. So in between, there's redemption. There's a new purchase which is happening. They can't do it on the same date, the same proportion, they will not be able to do it. That's a tracking error. Because of the tracking error and the expense ratio, they generate less than index return. Though they charge you less, they deliver less than index return. Though actively managed funds charge you higher fee, they deliver higher return than index. The only caveat here is you should have a good mutual fund distributor or a financial planner who can help you select a good actively managed funds. If you don't have that synergy, if you don't have that relationship, then you have to settle for the average index funds you have to settle for. So between index funds and active funds are much better.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.